But you can pretty much expect that if you buy a property and you hold on to it for a very long time, like I'm talking like over 10 years, you're probably going to see the value of your property go up. So by literally doing nothing, by just holding onto your property, obviously making your monthly payments every single month with your mortgage lender, your property value is naturally going to go up because real estate naturally appreciates over the course of time. For example, of the $450,000 loan balance, let's say after 10 years, I don't know, you've paid off $50,000. So $50,000 of principal payments later, now loan balance is $400,000. A $500,000 property that you bought, now your loan balance is $400,000 because you've been paying down the principal. That means that your equity theoretically would be $100,000, but you've held on to it for 10 years, which means the real estate market has increased. Let's just assume that now your property is worth $600,000 over 10 years, it appreciated by $100,000. In mind, we can kind of calculate that now the equity in your property is equity from paying down the principal and your equity from the appreciation of the real estate market. So now your equity is $200,000. So what exactly can you do with this equity? Okay, because one thing about equity, it is not liquid. It's not just liquid free cash that you can pull out. You can't just like on a whim decide, oh, I want to free up my $200,000 worth of equity. Let me just sell my property real quick. It's a whole process. There are fees associated with selling real estate. To pull your equity out of a real estate investment, you have several options. The first option, you could sell the property. This is probably the most common thing that people do. So in selling the property, you'd sell it for $600,000, let's say, going back to our original example. Mortgage lender would get their $400K paid off. Whatever else after selling costs, that's yours. You will be taxed on it. There are short-term capital gains, there are long-term capital gains. There are certain tax exemptions, like Section 121 is a good one to look into if you're selling your primary residence. If you're a real estate investor selling a rental property, a 1031 exchange is another great option. There are ways that you can pull money out of any real estate that you own. It can be a home that you live in, it can be a rental property. You could do a cash out refinance, or you could do like a HELOC, which is a home equity line of credit. HELOCs kind of operate similar to a credit card, whereas a cash out refinance, you're changing your mortgage loan, you're changing your interest rate, and you're getting a lump sum out of it, whereas a HELOC is kind of like a line of credit. It's like a credit card. Pulling equity out of an asset and getting that money will cost money. It costs money to do the refinance. It costs money to do a HELOC. There's interest paid on these things. And then obviously you have capital gains tax. And if you like all things real estate and real estate investing, I'm your girl.